Hello everyone, I'm Rachel. Welcome to the Economic Corner, where we update you on all the biggest global economic announcements. Let's get started with today's show. First up on the Economic Corner is an update from the world of cryptocurrencies. The price of the world's largest crypto, Bitcoin, has now crashed more than 10% in the last 24 hours as China further tightened the noose on crypto mining. Bitcoin is now trading at a price less than half of its peak value it touched in April 2021. With this, the market valuation of Bitcoin crashed $590.6 billion US dollars, way lower than the $1 trillion US dollars it touched a few months back before coming under the bear's clutch. The crash has pushed the Bitcoin annual returns to a single-digit mark, as the year-to-date returns of Bitcoin now stand at 9.88%. Other cryptos were also in the red as the Chinese obsession with banning crypto mining continued. Bitcoin tumbled almost 11% on Monday, while other digital coins like Ether dropped as much as 16.24%, falling below $2,000 for the first time in around a month. Tesla boss Elon Musk's favorite cryptocurrency, Dogecoin, also witnessed a meltdown, crashing 37.48% to trade around 17 cents. Chinese mines power nearly 4/5 of the global cryptocurrency trade, even as domestic trading has been prohibited since 2017. However, in recent months, many provinces have asked the mines to close, as Beijing is keeping a hawk's eye on the industry. Authorities in the Sichuan province are said to have ordered the closure of 26 mines last week. That's according to a notice widely circulated on Chinese social media. China's central bank warned several of its largest state-owned banks and Jack Ma's Alipay to investigate and identify bank accounts facilitating cryptocurrency trading and block all corresponding transactions in Beijing's latest move against Bitcoin. Not just the crypto, Chinese policymakers are watching soaring commodity prices closely too. Beijing has launched a review into record prices for key steelmaking ingredient iron ore. This means opening another front in its campaign to suppress high commodity prices. In a statement issued on Monday, the National Development and Reform Commission, China's top economic planning agency, said it would investigate malicious speculation in the iron ore market and severely punish any wrongdoing. The move marks the latest step by Chinese policymakers to cool soaring commodity markets, which have pushed factory gate prices up in China to their highest since 2008 financial crisis and threatened to squeeze industry profits. Chinese authorities made a pledge last week to release government stockpiles of industrial metals to tackle concerns over shortages and high prices. China is the world's biggest consumer of seaborne iron ore, absorbing more than 70% of global production. Iron ore futures tumbled on the news. In the physical market, where miners and steel mills buy and sell iron ore, it was down 5%. The price of iron ore surged to a record high of more than $230 a tonne in May on strong demand from China and supply disruptions in Australia and Brazil. On that note, it's time for a very short break, but stay tuned with Kalkine TV. I'll be back very soon with more updates.
This is Andy Lou broadcasting from Kalkine Media Studio in Australia, and I'll be hosting the new Kalkine Wellness Show. The half-hour show will cover topics from how wellness as a concept has become even more significant during COVID, to how becoming vegan may improve your health, and much more. We are excited to showcase our live streaming show to our audience of millions overseas and in Australia. Tune in to Kalkine TV and join me.
And welcome back. I'm Rachel. You're watching the Economic Corner. Moving on to an update coming in from the Fed. A senior Federal Reserve official says the US economy was not yet ready for the central bank to start pulling back its hefty monetary support. The comments from John Williams, the president of the Federal Reserve Bank of New York, were delivered on Monday amid high sensitivity in financial markets due to Fed policy. Economic projections by the central bank officials last week signalled that they expect to increase interest rates in 2023, a year earlier than previously indicated. Williams says the economy was getting better all the time in some of his most bullish remarks since the pandemic started, but he insisted the Fed would stick to the terms of its monetary policy framework. He said that though it's clear that the economy is improving at a rapid rate and the medium-term outlook is very good, the data and conditions have not progressed enough for the Federal Open Market Committee to shift its monetary policy stance of strong support for the economic recovery. Meanwhile, Fed Chair Jerome Powell says the Fed will do everything to support the economy for as long as it takes to complete recovery. He added that inflation has increased notably in recent months as transitory supply effects abate. He expects inflation to drop back towards 2%. Both Powell's prepared testimony and Williams's remarks suggest the top brass at the Fed are more cautious on the prospect of a quick policy change. Now let's focus on some important economic data announcements. Household confidence levels are on the rise. The Westpac McDermott Miller Consumer Confidence Index rose by 1.9% in the June quarter, taking it to a level of 107.1. Although that's still a little below its long-run average, consumer confidence has been trending higher in recent months and has now recovered most of the drop we saw following last week's outbreak. Underlying this rise in confidence levels, increasing numbers of households have reported that their financial position has improved over the past 12 months. Household confidence is on the rise, underpinned by a strengthening in broader economic conditions, which is expected to continue over the year ahead. Households are spending more on entertainment activities, but there's still some trepidation with regards to making major purchases for the home. While confidence among those aged over 30 is now back around average levels, confidence among younger New Zealanders remains low. But this isn't just a post-COVID bounce. New Zealand's economic recovery has been gaining traction in recent months, with a firming in activity seen across regions and sectors. Importantly, that includes the household sector, with a strengthening in the labour market, strong increases in retail spending and continued gains in house prices. On that note, it's time for a short break. Stay tuned with Kalkine TV as I'll be back with more updates.
At Kalkine TV, we'll take you to the heart of the Australian equity market. We'll bring you breakthrough stories that highlight volatility, as well as tailwinds building across the length and breadth of markets. Whether space travel will gain momentum, while economies may gradually open amid vaccine rollouts, our experts will share their timely inputs. So join us on this exciting journey of live streaming, financial and stock market news. Kalkine TV.
And welcome back. I'm Rachel and you're watching the Economic Corner. Moving on to the next news now. According to a new Fitch ratings report, the 2021 institutional US loan default rate forecast has been lowered to 1.5% from 2.5%, reflecting continued capital market confidence as constricted sectors reopen. The anticipated 1.5% default rate would be the lowest rate since 2011, when it dropped to 0.6%. The year-end default rate could finish even lower than the projection if the current strong environment continues. Year-to-date default volume totals $4.6 billion, compared with $37.1 billion 1 year earlier, the lowest recorded since 2011. Technology, healthcare, pharmaceuticals and the miscellaneous, the three largest sectors of the $1.5 trillion institutional loan market, are all projected to finish the year with default rates at 1% or lower. The leisure and entertainment default rate forecast remains high at 14%, but could finish well below last year's 9.9% level if Cineworld Cinemas and Travelport avoid defaulting. Lastly, some updates from the pandemic recovery phase. Canada's border chief said the US border is unlikely to be completely reopened until 75% of Canadians were fully vaccinated. The world's longest undefended border has been closed to most travel since March 2020. On Friday, Canada extended the restrictions until at least July 21, though it's expected to announce the easing of some rules for fully vaccinated citizens. Canadian citizens and residents who've received 2 shots will be exempt from a 14-day quarantine on arrival to the country. Travellers will still need to show they've tested negative for COVID-19 before they cross into Canada and take a second test at the border. Those travelling by air who are currently expected to do the first 3 days of their quarantine in a hotel will be exempt from that requirement. Meanwhile, Japan will limit spectators at the Olympic Games to 50% of a venue's capacity, capped at 10,000 people. It marks a rejection of last week's request by Shigeru Omni, the doctor leading Japan's COVID-19 response, for organisers to hold the Olympics behind closed doors. The Olympics were due to start on July 23. Japan has so far given a first dose of vaccine to 16 in every 100 people, with priority going to medical personnel and then the elderly. That's all from me for now, but keep watching Kalkine TV as we bring you the latest news and trending market updates live from Sydney. I'm Rachel, signing off for now.